Let's talk about the 2008 financial crisis. It was one of the biggest economic shocks in modern history.
So what was the problem? At its core, way too much money was being borrowed for risky home loans.
And when people couldn't pay those loans back, well, the entire system started to collapse.
This all happened incredibly fast. The real crash hit hard in 2008, shaking the whole world.
Right. The big question is, how did things go so wrong so quickly? Let's break it down.
The best way to get it is to think of a giant tower, one built with really shaky blocks. So what are these shaky blocks? They're those risky home loans given to people who might not repay. Everyone just kept building the tower higher and higher, stacking these loans, all chasing bigger profits.
The attitude was basically, just keep stacking. What's the worst that could happen?
But the problem was, the whole thing was built on an incredibly weak foundation.
Then, some of those bad loans, the blocks at the bottom, started to fall out.
Suddenly, everyone realized, wait a minute, the bottom's cracking. And then, the whole thing just came crashing down.
It was a massive domino effect. One failure just triggered the next, and the next.
And the consequences were just devastating. Huge banks failed, markets tanked, and millions lost their jobs.
The shockwave hit ordinary people the hardest. They watched their savings just disappear.
So, to recap, the shaky blocks were the risky loans, and the tower's collapse was the entire financial system failing.
The lesson here is pretty simple. If your foundation is weak, the whole structure will eventually collapse.
Which really makes you wonder, right? Have we actually learned enough to prevent this from happening again?